Standalone versus consolidated financial statements. Financial statements are very crucial while doing fundamental analysis of a company. Financial statements are available in company's annual report. Financial statements provide information on debt and liabilities of a company, its balance sheet, cash flow statements, and also profit and loss statements are provided in financial statements of a company. Through balance sheet of company, one can analyze inventory and assets of a company. Every company has to make balance sheets and cash flow statements. Cash flow statements is created to determine how much money has flow inside and outside of company. Cash flow statements are created mostly on three parameters: business operations, cash inflow, total business income and profit. Cash outflow, business expenses. Investment cash inflow, when company sell fixed assets or shares. Cash outflow, when company buy fixed assets. Finance cash inflow, to collect money from general public company issued debentures. Cash outflow, dividend on company shares or interest in debentures. There are two types of financial statements: standalone financial statements, consolidated financial statements. Standalone versus consolidated financial statements. What's the difference? Standalone versus consolidated. Standalone financial statement only have information about own company's asset and liabilities, while consolidated financial statements have information about parent company as well as information about its subsidiary company. For instance, let's assume that you own company ABC Limited, but to expand your business you need my company's XYZ Limited products. So, you bought 60% shares of XYZ Limited. After that, ABC Limited will be known as parent company and XYZ Limited will be known as subsidiary company of ABC Limited. As you have 60% share in my company, so you can control board of directors of XYZ Limited and can make decisions. Now, as you own the parent company XYZ Limited, you have to provide two types of financial statements. As per rules, companies those who have consolidated have to prepare two types of financial statements for quarterly results after every 3 months. So if you want to do stock analysis of any parent company who have intervention in management of its subsidiaries or have control in company's board of directors, then always consider consolidated financial statements for stock analysis and to calculate P/E ratio. But if parent company's subsidiary have very different business model and parent company doesn't have much power in the board of directors or decision making in that subsidiary, then always do stock analysis on basis of standalone financial statements. For instance, ICICI Limited, where parent company doesn't have much intervention in management of its holding companies, so while doing stock analysis of companies like ICICI Limited, one should do it on basis of standalone financial statements. We hope you enjoy reading this article. If you have any questions or doubts regarding this post, please comment below. We will do our best to help you out. Disclaimer: investment in securities market are subject to market risks. Read all the related documents carefully before investing. Please read the risk disclosure documents carefully before investing in equity shares, derivatives, mutual fund, and/or other instruments traded on the stock exchanges. As investments are subject to market risks and price fluctuation risk, there is no assurance or guarantee that the investment objectives shall be achieved. Past performance of securities/instruments is not indicative of their future performance. This post is only for educational purpose.